Welcome to the Rob View, ladies and gentlemen. I'm your friend in success, Robert Morris, and today I want to talk about earnings versus warnings, 2,000% returns versus mediocre. 2,000% returns, earnings versus warnings is the idea, title of this video. What do I mean by that? We all know that the market is driven by earnings and interest rates. That's the two main drivers. All those other things kind of fall under that umbrella of earnings and interest rates. Typically, when interest rates are low, earnings are high. Right now, we see a strong bull market despite the interest rates. And that's where suspect comes into play, right? A lot of people are talking about the overpriced and overvalued, just pumped up prices of most of the stocks out there. I can agree. But a lot of people aren't doing splits anymore, so that's how that happens. What's the difference between a 2,000% return versus everybody else? Well, you can never know what your return is going to be. But I am a big proponent of only trading the catalysts that allow you to have the best shot at winning. And, I'm not a baseball player. My brother was. I was a semi-pro skeet shooter. So in my sport, you always have a particular pattern that you're looking to set your gun up for. And you always look to pull the trigger the same way, breathe just so, have your mind focused on breaking the target. And in baseball, I did play, you step up to the plate, and if you swing at everything, eventually you're going to learn, okay, my strike zone for my body, for my swing, for what I'm looking for is in this particular area. You learn your strike zone. Some of the best batters out there only swung at what they saw fit their comfort of a strike zone. So having 2,000% return, first of all, can be a life-changing trade, because at $20,000, let's say you put 20 grand into a trade. I don't want to do math wrong on YouTube. So let's just, it's $400,000 return in one trade. For me, that's life-changing money. But you never approach it thinking that's going to happen. It's just, you chalk it up as, man, that buck pranced right out into my sight, and I dropped him because he was there, and he's got a beautiful rack on him, and I'll mount him as a trophy. And then you go right back to hunting for meat, because you're in the market to eat, not to kill trophies. That being said, your best bet for getting a 2,000% return is to trade around known catalysts. And right now, one of the best ones is earnings. It happens every 90 days. And I can tell you that most stocks have patterns that set up either pre or post earnings. Most stocks have a 3-week window, either pre or post earnings, where the movement from earnings takes them off in a direction. And usually you can look for that direction to be going with the market, unless you're in a bear market scenario and the company has really good earnings, or if you're in a bull market scenario and the company has really terrible earnings, or they warn, which is why the difference. I don't trade warnings. I don't look to trade earnings during warning season. I only trade earnings during January, February, April, May, July and August, and October and November. The other 4 months, warnings months, March, June, September, December, those months are a lot less active for me as a trader. Doesn't mean I don't do trades, but I do a lot more catalyst trading of earnings during earnings season, and my money sits on the sidelines a lot more if you look at my trading chart during those other 4 months. That's because I know the strike zone that's going to work for me. And I'm going to swing when I know I got earnings momentum moving in my favor. Whether it's the idea that they've had good earnings going up and people have seen that the numbers are possibly going to be good this time and there's whispers. Whether it's you know that the company has set up every year, 3 years past, historically speaking, around this time to move into earnings, you can set yourself up to have the best possibility of hitting that good knocking out of the park home run. And if you land on a base hit, that's okay because it's still profit. That being said, earnings can be a place where the entire market moves because of the momentum of earnings. And not all earnings are created equal. January and February are really the best earnings of the year. October and November, good earnings. The other ones, July, August is kind of lackluster earnings. April, May, kind of lackluster earnings, but you can still make money. The proof is in trading around the catalyst. Focused trading around the catalyst. And knowing, going into ahead of time, before the release, what the history of that stock is. The historical norms. Because historical norms let you know what that pitcher is going to be throwing. Fast, slow, curve. Is he good at that? Is he better at a fastball? Study your opponent. And your opponent is that stock in this particular scenario. Now, that being said, I have had earnings trades that I have traded right up through earnings. The problem with that is that you do take on added risk because you don't ever know if a stock is going to tank right after earnings. So there's a thing called insurance. Everybody has it when they drive. You should have it on your life. You should also get it on your trade if you're going to trade through earnings. You should buy a mimicked amount of contracts to mirror the opposite side of the trade that you're in if you're going to go through earnings. Instead, I prefer, unless I have a huge profit going into earnings, to get out the day before earnings is supposed to release. And I've never found myself really getting burned by, there's so much data out there now that you can pinpoint the earnings date pretty accurately without paying for a subscription service. That's all I got for you today, ladies and gentlemen. Remember, if you can make $1 million, you can change your life. And that starts with making the first dollar, and then the 10,000, and then the 100,000. And so if you can make $1, you can make $1 million more. I'm your friend of success, Robert Morris. I'll see you on the next one. Okay, guys, that's all I got for you today. I need to call my wife and check on the AC thing. So I'll see you on the next one. Keep in mind, this is a live thing. We're trying to do it on a regular basis. So hopefully, God willing, I'll see you next week. I'm your friend of success. Look, the stock market is about consistency over time. Make your plan, trade your plan, execute your plan, and know that you're going to benefit best if you focus on long-term wealth and use the stock market to be the vehicle to get you to buy those companies and build a position in, because wealth does come from investing, not trading. Trading is just a asset generating activity that allows you to have more capital than you would otherwise have to invest when the time is right, to invest in companies that you've already done research on and know you want to own. Got to play the disclaimer for you guys.